Despite headlines declaring the death of the 60/40 portfolio, at Howland Russling, we remain committed to its core principles of why traditional asset allocation matters. While 2022 proved to be a challenging year for both stocks and bonds, we continue to believe that thoughtfully diversified portfolios built on time-tested principles offer a resilient framework for long-term investing. Here at Howland Russling, we believe a portfolio built from stocks, bonds, and ETFs is sufficient for most investors' long-term objectives because it delivers the three things that tend to matter most: return potential, risk management, and practicality. First, stocks have historically provided the primary engine for long-term growth. While there have been periods in history where stocks struggle, generally, if an investor is patient, these investments can help grow wealth. Diversified equity exposure captures market returns across sectors, company sizes, and geographic areas, which have historically outpaced inflation and produced the compounded return needed to meet long-term goals. Second, bonds supply ballast, predictable income, lower volatility, and lower correlation to stocks at times when equities fall. There have been periods where bonds have had a higher correlation to stocks, and 2022 is the most recent example. That stability may reduce sequence of return risk or the danger that the order and timing of investment returns, especially large negative returns, occur during the period you are withdrawing money, such as in retirement. Because of this, bonds may smooth the path to goals such as retirement, education funding, or legacy transfers. With interest rates at their highest level in many years, bonds may play a meaningful role in a portfolio construction. Together, a deliberate allocation between stocks and bonds lets you fine-tune return versus risk to your personal time horizon and risk tolerance. Third, ETFs, or exchange-traded funds, may offer relatively low expense ratios, intraday liquidity, and transparent holdings compared to some other investment vehicles. ETFs may provide an efficient way to gain market exposure and can help support diversification. ETFs may also help streamline implementation tasks such as rebalancing, tax management, and portfolio monitoring. These operational considerations can be important because costs and execution may influence overall outcomes. What about alternative investments as an asset class? By contrast, there are alternatives which have become more mainstream in their popularity and reputation as of late. These investments are things like private credit, private equity, hedge funds, and structured notes, which introduce real trade-offs: limited liquidity and long-term lockups, opaque and infrequent reporting, high and layered fees, and complexity that might make it quite hard to measure or control risk. They can add value in specialized cases. I tend to think very high net worth investors or folks with concentrated liability matching or tax sensitive strategies. But for most investors, those drawbacks outweigh potential incremental returns. Importantly, many alternative exposures can now be accessed through ETFs or diversified public market strategies that retain liquidity and transparency without sacrificing the intended payoff. In short, we continue to like stocks for growth, bonds for stability and income, and ETFs for efficient implementation in an attempt to give clients a low-cost, liquid portfolio in which we know what we own and why. It's one of the attempts to capture market returns, manage risk, and it's easy to maintain. We believe that combination is sufficient and possibly even superior for achieving long-term investment objectives for many investors. Stocks, bonds, and ETFs remain sufficient for most long-term goals, and we can further enhance outcomes by adjusting allocations and applying tactical strategies within those asset classes. By shifting the stock-bond mix, we align risk with your time horizon, your goals, and within those buckets, we can implement tactical and strategic tilts without resorting to illiquid, high-fee alternatives. Markets evolve, asset classes shift, but the core principles of diversification, discipline, and transparency remain constant. By focusing on quality traditional investments and tailoring them to each client needs, we aim to provide our clients with a foundation that adapts across market cycles, helping them stay on course toward their objectives.